Hey everyone, this is David Wickwire with the Wickwire Group. I am a licensed realtor as well as a licensed lender, and today we're going to talk about pre-approvals. Pre-approvals are super important, and that should be the first step in your search for a new home. Really important to have a pre-approval letter from your lender before you go out and actually look for that new home. Say you're out looking on a weekend and you find the perfect place. Without a pre-approval letter to submit with your offer, no one's going to take the offer seriously, so you may just lose out. So you really want to make sure you contact your lender and not just get a pre-approval letter, but make sure it's a thorough, real approval. If the lender hasn't asked for your permission to pull credit, and if they haven't collected income statements or tax returns to verify your income, and the credit report to verify your liabilities, then it's not a real pre-approval letter. And you could submit an offer with a letter that's not properly vetted, and the listing agent will then contact your lender to verify that all those things have been done. And if they're not confident that those things have been done, even though you may have the best offer, it may not be accepted. So you want to have a pre-approval letter and make sure it's properly done. With respect to credit, a lot of people will pursue multiple lenders and get interest rate quotes from multiple lenders. I've heard a lot of questions about what does it do to my credit score. Typically the first pull will drop your score about 5 points. But what the credit agencies have come to realize is that a lot of people look for cars, look for home loans, and they contact multiple vendors. So if they see multiple credit requests from lenders and people pulling credit in the same industry 3, 4, 5 times in a month, those pulls will piggyback on top of the first one, so it will only hit your credit the one time, and typically 30 to 60 days later those points they go back to your score. So really it's not that big of an impact, so don't worry about that. Obviously you want to save for a down payment on your home, and the larger down payment the better. Obviously if you can put a down payment of 20% or more, not only are you going to have a smaller loan, smaller payment, but you're also going to avoid what's called mortgage insurance. With a conventional loan, private mortgage insurance, with an FHA loan, mortgage insurance premium, it's insurance that is put on your monthly payment to protect the lender in the case of a default. And you're more likely to default on your loan if you haven't been able to put more money down, at least 20%, and you're not as vested in the property. So that's why putting more money down is not only making your payment less, but even then more so by not having the mortgage insurance included in your payment. But in addition to closing costs, or in addition to down payment, you have to consider closing costs. That's something that a lot of people miss when they're budgeting to buy a home. Closing costs are typically 2.25% to maybe 3% of the purchase price. So closing costs include appraisal, recording fees, state taxes, title insurance, prepaid interest, and then they also have to set up an escrow account so that your homeowner's insurance and property taxes are going to be paid on time. Depending on the time of the year, it could be a significant amount. So when you're budgeting for your new home purchase, down payment super important, but don't forget about those closing costs when you're calculating when you're ready to pull the trigger on a new home purchase. And reach out to us here at the Wickwire Group, and we're happy to help you through the real estate process and also guide you through the lending process. Thanks a lot. Have a great day.